Assalamualaikum warahmatullahi wabarakatuh. First of all, I want to greet Miss Yuti Yuniarti MPD as my English lecturer. Hello Miss, welcome to my videos. I hope you enjoy it, and of course, I want to say thank you for audience to watch this video. Let me introduce myself. My name is Dini Ashifah Suparman, and in these videos, I will discuss about balance sheet. There are so many people who don't understand the balance sheet. What is a balance sheet? Also, how to understand the information in the financial statement and use it as a basis for making decisions when doing business. Well, to answer this question, let's look back at the explanation of the balance sheet along with the following elements, example, and benefit. What is balance sheet? Okay, the balance sheet is one of the three fundamental financial statements and is key to both financial modeling and accounting. The balance sheet displays the company total assets and how the assets are financed, either to either debits or equity. It can also be referred to as a statement of net worth or a statement of financial positions. The balance sheet is based on the fundamental equations, assets equals liabilities plus equity. Simple balance sheet. As such, the balance sheet is divided in two sides or sections. The left side of the balance sheet outlines all of a company's assets. On the right side, the balance sheet outlines the company's liabilities and shareholders' equities. There are two forms of presentation of the statement of financial position, namely staff or report and control or accounts. I use the example of presenting a report in the form of a staff. Below is an example of Amazon 2017 balance sheet taken from CFI's Amazon case study course. As you will see, it starts with current assets, then non-current assets, and total assets. Below are liabilities and stockholders' equity, which includes current liabilities, non-current liabilities, and finally, shareholders' equity. How the balance sheet structure? Balance sheet, like all financial statements, will have minor difference between organizations and industries. However, there are several buckets and line items that are almost always included in common balance sheet. We briefly go through commonly found line items are under current assets, long-term assets, current liabilities, long-term liabilities, and equity. Number one, current assets is types of assets that have a useful, live or short-term use. Example, cash and equivalent, account receivable, and inventory. Number two, non-current assets is a type of assets or wealth that is used or owned by a company for a longer period of time, usually more than 1 year. Example, parent property and equipment or PP&A and intangible assets. Number three, current liabilities is a type of debt that needs to be repaid immediately and has a deadline of no more than 1 year. Example, account payable, current debit or notes payable, and current position of long-term debits. Number four, non-current liabilities is all debts or credits whose payments tend to take longer. Example, bonds payable and long-term debits. And the last, shareholders' equity. Equity or capital is defined as the difference between the component of assets and debts. The calculation usually uses the formula assets less liabilities equals equity. The capital component of the balance sheet is the ending capital balance of a business. Example, share capital and retained earnings. Benefit of balance sheet. Number one, useful as a tool for analyzing change in the financial condition of a company periodically from year to year. Number 2, useful as a tool for liquidity analysis of a business entity so that it is now the ability of a company to perform its obligation with liquid assets. Number 3, useful as a tool for analyzing a company's ability to pay off short-term debt before maturity. Thank you for watching my video and I hope the video is useful for all of us. Thank you so much. Wassalamualaikum warahmatullahi wabarakatuh.